Every time you swipe a credit card, a hidden toll gets collected before you even leave the store. You paid $10 for that coffee, but the merchant only got about $9.70. That missing 30 cents is called the interchange fee, and it powers a giant industry. Most people assume credit card companies make money by charging you interest, and they do. But the truly clever part is that they get paid even when you never owe a cent. Let's follow a single swipe and watch where your $10 actually goes. When you tap your card, the store isn't talking to your bank directly at all. There are actually 4 separate players hiding inside one 2-second transaction. First, there's you, the cardholder, spending money you may or may not have. Second, the merchant, who just wants your money to land in their account. Third, the issuing bank, the company whose name is printed on your card. Fourth, the acquiring bank, which quietly handles the money on the store's side, and sitting in the middle running the whole highway are Visa and Mastercard. Here's the twist. Visa and Mastercard don't actually lend you any money at all. They're not banks. They're toll roads that charge a fee for every car that passes. So when you spend that $10, the network takes a tiny slice just for routing it. The bigger slice, the interchange fee, goes to the bank that issued your card. Interchange typically runs between 1% and 3% of everything you buy. On a card that gives rewards, that fee tends to sit at the higher end, which raises an obvious question. Who is actually paying for your cashback and airline miles? The answer is the merchant who baked those fees into the price of everything you buy. Stores can't easily charge card users more, so they raise prices for everyone. That means the person paying cash is quietly subsidizing the person earning miles. It's a reverse Robin Hood where cash users fund the rewards of card users. Now let's talk about the part everyone knows: interest, the second giant money machine. Credit card interest rates in the United States often sit above 20%. If you carry a balance, that rate compounds against you month after month. The bank borrows money cheaply and lends it to you at a huge markup. That spread between what they pay and what you pay is pure profit. And here's the counterintuitive secret that makes this whole business hum. Banks make the most money from the people who don't pay off their balance. The industry actually has a nickname for people who pay in full: deadbeats. In their eyes, a responsible customer who owes nothing is barely worth having. The dream customer is the revolver who carries a balance forever and never quite escapes. That's why rewards exist at all, to get you swiping and, ideally, borrowing. Every point and every bonus is a fishhook, baited with your own future money. American consumers now carry well over $1 trillion in credit card debt. On that mountain of debt, interest charges pile up into tens of billions per year. But interest is just the beginning. The fees are where things get quietly brutal. Miss a payment by one day and a late fee lands, often around $30. Late fees alone bring the industry billions of dollars every single year. Spend money abroad and there's a foreign transaction fee, often around 3%. Take out cash from your card and you'll pay a cash advance fee plus instant interest. Cash advances usually skip the grace period, so interest starts ticking that same day. Some cards even charge an annual fee just for the privilege of owning them. Premium cards can charge hundreds a year, marketed as luxury and status. Companies bet that flashy perks make you forget the $400 sticker. Now let's zoom out and total up all the ways your card is quietly earning. Interchange fees, interest, late fees, annual fees, and foreign fees all stacked together. Each stream is small on its own, but multiplied across billions of swipes, it's enormous. Visa and Mastercard together process trillions of dollars in payments each year. And because they're just toll roads, they barely have to lend or risk anything. That's why Visa is one of the most profitable companies on the entire planet. Their profit margins put oil giants and tech titans to shame. For every dollar of revenue, the network keeps around half as pure profit. Now think about why you almost never notice any of this happening. The genius of the system is that the fees are invisible at the register. You see $10 on the tag and you pay $10, so it feels free. The merchant absorbs the fee and hides it inside the shelf price you already accepted. So the toll gets collected on you, but you never see the toll booth. This invisibility is exactly why cash discounts feel strange to most shoppers. That discount is really the merchant handing you back the fee they'd otherwise lose. In many countries, regulators have capped these interchange fees much lower. In Europe, debit interchange is capped near 0.2% by law. In the United States, those fees stay high and the rewards culture stays wild. High fees fund big rewards, and big rewards keep you addicted to swiping. It's a self-reinforcing machine that keeps everyone spending more than they planned. Studies show people spend significantly more with a card than with cash. Paying with cash hurts because you physically watch the money leave your hand. A card mutes that pain, so the brain treats the purchase as almost imaginary. That gap between spending and feeling it is worth a fortune to the industry. Buy now, pay later apps are just the same trick wearing a friendlier costume. They split your purchase into 4 payments and make you feel financially clever. But miss one installment, and the fees arrive right on schedule. Let's go back to that original $10 coffee and finish the money trail. The merchant hands over roughly 30 cents in total fees for that sale. About 25 cents goes to your bank as interchange for issuing the card. A few cents go to the network as a toll, and a bit to the acquiring bank. Your bank then hands you a cent or two of that back as your reward. You feel like you won, but you funded the whole system with your own spending. The rewards you love are just a small rebate on the fees you already covered. So who actually profits from all of this? Follow the biggest arrow. The networks win by owning the road that every dollar has to travel on. The banks win from interest, fees, and the interchange on every swipe. Merchants lose a slice, but they mostly pass the cost on to all of us. And the disciplined cardholder who pays in full comes out roughly even, maybe ahead. The person who really loses is the one carrying a balance at 24%. For them, one nice cashback point is dwarfed by dollars of monthly interest. That's the entire business model in one uncomfortable sentence. The industry earns from your convenience and earns even more from your mistakes. Now here's a detail that makes the whole picture even sneakier. The minimum payment on your statement is engineered to keep you in debt longer. Pay only the minimum, and a small balance can take years to disappear. A $1,000 balance at minimum payments can cost you hundreds extra in interest. That small number on your bill is a quiet invitation to stay a paying customer. Introductory 0% offers work the same way, betting most people won't finish paying. When the teaser period ends, the regular sky-high rate snaps back into place. Some deferred interest deals even charge you retroactively if you're a day late. The fine print is where the real profit quietly lives. Now consider the credit score, another invisible lever pulling on your wallet. Your score decides your interest rate, which decides how much profit they extract. A lower score means a higher rate, which quietly costs you thousands over time. So the system rewards trusted borrowers and squeezes the ones who can least afford it. Meanwhile, every swipe you make generates data the companies quietly monetize too. They know what you buy, when you buy it, and how to nudge you to buy more. Anonymized spending data gets sold and analyzed for yet another revenue stream. So the card earns off your spending, your borrowing, and even your behavior. It's honestly one of the most beautifully designed money machines ever built. And yet, none of this means credit cards are automatically a bad deal for you. Used carefully, a card is a short-term loan you pay back for free every month. That grace period is genuinely one of the best free features in finance. Pay in full, and you get fraud protection, rewards, and a free loan every cycle. The whole game is simply staying on the right side of that grace period. Cross that line into carrying a balance, and you flip from beneficiary to product. The companies bet, on average, that plenty of people will cross that line. And statistically, across a whole country, that bet pays off spectacularly. That's why banks fight so hard to get their card into your wallet first. The card at the top of your wallet is the one that earns the most. That sign-up bonus of miles or cash is an investment in your future spending. They give you 50,000 points because they expect far more back over time. Everything about the design points you toward one goal: swipe more, swipe often. The tap-to-pay convenience isn't a gift. It's frictionless spending on purpose. Every removed second of hesitation is a few extra dollars of spending unlocked. Storing your card in apps and browsers makes it even easier to forget your spending. The less you feel the money leave, the more of it tends to leave. So the next time you tap your card, picture that little 30-cent toll. Picture it splitting into pieces, flowing to banks and networks around the world. Picture the rewards trickling back to you as a small, calculated rebate. And picture the whole machine humming happily as long as you keep swiping. The trick to winning is boring, but genuinely powerful. Pay in full. Always do that, and you flip the toll booth around to face the other way. You take the perks, dodge the interest, and let others fund the party. But the whole industry is betting quite confidently that you won't, because the average balance carried by American households runs into the thousands. That average is the entire foundation the profit machine is built on. So a credit card is less a payment tool and more a finely tuned business model. It profits from convenience, from borrowing, from fees, and from human nature itself. And the most brilliant part is how invisible the whole thing stays. You feel like a customer being served when you're really the product being farmed. The good news is that understanding the machine is exactly how you beat it. Know where the money flows, and you decide which side of the toll you're on. So next time someone brags about their travel points, you'll know the real story. Those points were paid for by fees, by cash users, and maybe by their own interest. The card that feels free is quietly one of the most profitable products in history. And now you can see the toll booth that was there in every swipe all along. So swipe smart, pay in full, and let the machine work for you instead.